If you are purchasing a car, estate or any other liability and want it insured, watch till the end to learn how you could save yourself some money, and even potentially make more. Legally, of course. You don't have to simply accept the first quote you get from an insurer. There are plenty of legal tactics you can use to cut the cost of your cover. 1. Paying annually. Insurers will give you the option to pay for your cover in two ways: as a lump sum or in monthly installments. While paying monthly might seem like a sensible way of spreading the cost, you may actually be charged hundreds more over the year. By paying in monthly installments, you are, in effect, taking on a loan from your insurer. Most will charge you interest for it, and rates aren't cheap. If paying monthly is your only real option, be sure when shopping around to compare the insurer's monthly, rather than annual, premiums. Or you could consider paying using an 0% purchase credit card. 2. Credit rating. If get a quote from an insurer, they will run a soft search on your credit report. This is to verify the accuracy of your personal information, such as name and address, and won't impact your credit score or be visible to other companies. If you then apply for insurance and opt to pay monthly, your insurer may then run a hard credit check. This information will help it decide whether to actually provide you the credit. Like any other credit application, this will be externally visible in your record and can affect how other lenders treat you. And in case of a default, it could really hurt your credit score. 3. Pick a dominating job title. There might be no difference between a writer and a journalist, or a housewife and a homemaker. But in reality, your occupation title could make a difference with your insurer. Insurers look at many factors when calculating the cost of covering you, and how you describe what you do for a living makes a difference. If you've got a choice of different labels when entering your occupation, check if there's a difference in impact to your premium. However, remember that you should never lie about your job. Don't say you're a dentist if you're a nurse. This is considered fraud and you could be prosecuted. 4. Don't blindly auto-renew. Come your policy's renewal date, it may be tempting to let your insurer do all the work and have your policy automatically continue. However, you're paying for this convenience, and probably paying even more if you've stayed with the same insurer for a few years. The renewal offer sent towards the end of each policy year is rarely the best your insurer would be willing to make. Customers who haggle save on their premiums. And if you don't shop around, you could be missing out on far better deals from rival companies. So how can you haggle? Your renewal offer should tell you the premium you paid the previous year. If you look closely, it has changed. So to save up, do some shopping around to get an impression of what your insurer's rivals will offer for your business, putting your renewal quote into context. If you can, see if you can also obtain an online quote from your current insurer. What would they offer you if you were a new customer? With the collected information, contact the firm and inquire why your renewal price has increased. Wait for the response. Then explain that you have shopped around, and provide details of the cheapest quote you have received. Ask them if they're prepared to better the quote. Await response and see what the call handler says. If they don't better the offer, you can push a little harder. Ask the responder for the lowest rate they can offer to keep you as a customer. If they're still not offering you a quote you're happy with, ask them what they would be prepared to offer you if you canceled your existing policy and bought a new one, as a new customer, with the same cover. 5. Comprehensive vs third party. Less cover isn't always cheaper. When it comes to choosing between levels of cover, buying more cover can sometimes lead to a lower quote. You're usually offered 3 varieties of car insurance cover. 1. Third party, TP. 2. Third party, fire and theft, TPF and T. 3. Comprehensive. Drivers who are typically offered the least competitive prices, such as younger drivers, may be tempted to a lower level of cover to reduce the premium. However, it's worth checking the prices of each level of cover, as sometimes comprehensive cover costs less than TP or TPF and T. The reason is insurers don't just price policies according to the level of cover but to how much they're paying out in claims for the drivers buying it. Where less comprehensive policies are bought overwhelmingly by drivers that tend to claim more, insurers will work this into their pricing, making them more expensive. This isn't always the case, but don't assume lower cover always means a cheaper deal. 6. Consider multi-car insurance. If you live in a household with more than one car, many insurers will offer savings for insuring them all together. Some insurers offer policies that will cover more than one car, while others enable you to link multiple policies together to earn a discount. This is likely to work out cheaper than separately covering several vehicles with the same company. Bear in mind, of course, that the value of a discount is entirely relative to how expensive the insurer was to start with. 7. Using named driver. If you're considered a high-risk driver, putting a lower-risk driver on the policy as a named driver can bring the overall premium down. For instance, drivers under 25, who face the steepest premiums, can benefit from having an older and more experienced driver on their policy. Bear in mind, however, that it's illegal to put someone down as the main driver if this isn't the case. This practice is known as fronting, and is a kind of insurance fraud that can lead to your policy being invalidated. 8. Car modifications. Insurers not only consider boy racer cars as being modified. Even a small modification to your car, such as new alloys, can cause your premiums to rise. If you're going to make any changes to your car, always discuss them with your insurer first. On the flip side, any modification to your vehicle that increases its safety could save you money. Installing an alarm, tracker or immobilizer can reduce your car insurance premiums. 9. Use black box to cut costs. Black box insurance, also known as telematics policies, use GPS devices in your car to track your driving. If your day-to-day driving passes criteria laid out by the insurer, these can range from not driving at specific times of the day, staying within a certain mileage, to measurements of your safety in cornering and braking, you'll be rewarded with discounts in your premium. These types of policy are most popular with, and generally aimed at, younger drivers, who face the steepest premiums. 10. Be a better driver. Insurers usually set your premium based on their experience of drivers that seem statistically similar to you. This could be in terms of age, locality, type of car owned. However, there are ways you can demonstrate that you're a better driver, which may help hedge things further in your favor. Certificates such as Pass Plus, for younger drivers, or from the Institute of Advanced Motorists can help set you apart and will earn you a discount from some insurers. More obviously, maintaining a good no-claims bonus and clean driving record will keep your premium low. 11. Consider a cheaper car. The make and model of your car is a major factor in how your car insurance policy will be priced. Cars are given an advisory risk rating by an organization called Thatcham Research. Thatcham works in conjunction with insurance trade body the Association of British Insurers to award ratings on a 1 to 50 scale, giving an indication as to how expensive it will be to insure. You can visit the Thatcham website and plug in your car's specs to see how high it features. A more direct route, of course, is to run insurance quotes on a prospective car prior to buying it. Car insurance can be a serious addition to its annual running costs, so factor this in before buying a new car. 12. Avoid scammers. These are fraudsters who sell insurance at too good to be true prices. They target drivers who have been struggling to find affordable cover. The catch is their policies are fraudulently obtained, often substituting some of the policyholder's details, such as their address, with those of lower-risk drivers, usually without either's knowledge. The car will seem insured on paper, with the policyholder having documentation to demonstrate it. However, when they try and make a claim, the policy would be revealed as fake. Scammers often operate on social media platforms, as well as student websites, money-saving forums, and marketplace websites. You can spot them with the following signs. 1. Guaranteeing a specific insurance price prior to securing a quote. 2. Lack of a professional-looking website. 3. Mobile phone number as a means of contact. 4. Offers that seem too good to be true.